All right, so it's 9 p.m. Eastern Standard Time. I was looking at my to-do list today, and what I do with my to-do list is I write a list of all the things that needs to be done the following day, and then I circle the top 3. Why do I do that? Because if I make an entire list of the things that need to be done, what happens when I only accomplish 3 of those things? Or what happens when I only accomplish 4 or 5 and it's a list of 10, 11, 12? Psychologically, I feel defeated, even though I did a lot, right? A lot compared to what I would typically do if I did not make a list for the following day. So what I do is I make a list of the things that need to be done, and then I circle the top 3. And if I knock out that top 3, if that's all I do for the day, I won. But if I get more done, if I do 4 or 5, 6 things, it's a beautiful thing, right? That's just icing on the cake. All right, the last thing that I have to do for the day is reread chapter 1 of this book. It's Health and Life, including Annuities and Variable Contracts. It's the 35th edition. And I get it, y'all. We some smart people, right? But who likes to read? Some people love to read. If that's not something that you are brought up doing, reading ain't all that fun. I almost hate it, but because I know how my mind works, I trick myself into thinking I love it, right? But what I'm going to do for y'all today is I'm going to be reading chapter 1. Listen, for most people, you'd have already stopped watching this video. Who wants to watch a random person read? But some of y'all, you're either studying for your pre-licensing for your 214 or your 215 life license. It might be called something else in your state. Each state, insurance is regulated by the state. Each state is slightly different, but for the most part, a lot of this stuff is the same. So some of y'all are studying for your pre-licensing, or you already got your license. You passed the test, but you're like, do I know this stuff? Really? I don't know. So I'm just going to be reading this verbatim, and I might chime in on some stuff I'm familiar with. And just to give you some of my background, I've been in the insurance and financial services industry for over a decade. I'm a chartered life underwriter, chartered financial consultant, chartered property casualty underwriter, Federal Life Management Institute, Associate Life Management Institute, Associate Insurance Regulatory Compliance, Associate in Customer Service as it relates to life insurance. It's a whole, the list goes on, but basically, and I'm a registered instructor, insurance instructor with the Florida Department of Financial Services. So I know something, or at least I circled a lot of bubbles on a lot of paper, or clicked a lot of ABCs on a lot of proctored exams to make it seem like I know something. But here we go. This is chapter 1, 35th edition of this book, right? Health and Life, including Annuities and Variable Contracts. Okay, so chapter 1, the purpose of life and health insurance, the role of insurance, an industry overview, the nature of insurance, the concept of insurance, economic basis of life and health insurance. The first step in the study of life and health insurance is to understand. Let me see. And I just hit record because what I just decided to do was simultaneously record some audio in addition to this video, so I can put it on a podcast. I'm trying. You gotta figure it. You gotta make this stuff work for you, baby. All right. So anyway, chapter 1, and for the people who just joined me on my podcast, I'm reading from the 35th edition, Health and Life, including Annuities and Variable Contracts. This is the 35th edition. This is chapter 1. Why should the people on my podcast need to know about this? Even though you're not a life insurance agent, it's because life insurance is one of the quickest and most sure ways of breaking generational curses and creating generational wealth. People bet on a lot of things. They bet on a lot of speculative bets, right? The chance of winning, the chance of losing. This might happen. This may not. One thing that you know for certain is that everybody that you know right now, everybody, look around. Look in your contacts list. They're all going to die. And if you didn't know that, I'm sorry to break it to you like this. But if you know that they're going to die, why not use that absolute definitive knowledge and break some generational curses and create some generational wealth? Family need to get together. Y'all put money in on the vacation. Put money in on the life insurance of the new members of the family. Make it a habit. Anyway, let me get off my box. But all right, so here we go. Chapter 1, the purpose of life and health insurance. The role of insurance, an industry overview, the nature of insurance, the concept of risk, the economic basis of life and health insurance. The first step in the study of life and health insurance is to understand the purpose these instruments serve, and the important role they play for individuals and for society. In this unit, we will take a look at the purpose and role of it by explaining the concept of risk and showing how insurance is uniquely designed to replace the uncertainties of risk with guarantees. (1.1) The role of insurance. Through the centuries, people have pursued financial security for themselves and those who depend on them. We all have a compelling need for security. Security is peace of mind and freedom from worry. Insecurity is doubt, fear, and apprehension. Who wants that, right? Doubt, fear, and apprehension? Sounds like cancer and early death to me. Anyway, most economic actions we take are to satisfy some need and thus attain some degree of security. Unfortunately, complete financial security has been elusive, in part because certain universal problems, death, sickness, accidents, and disability. These problems can strike at any time and without any warning. The emotional stress these problems bring is increased by the financial hardships that are almost certain to follow. What does that mean? When the breadwinner dies suddenly, the breadwinner of the family, the person who brings all the money home, puts the bacon on the table, what happens to the wife, to the kids? Even if the wife had a job, her income wasn't enough. Even your older kid had a job, his or her income isn't enough. Oh, you got to sacrifice their future because you didn't plan? And it's not just the husband that's the breadwinner. Sometimes it's the wife. What happens when the wife dies suddenly and leaves the husband? What happens? This is what happens. Hardship that is almost certain to follow. Death may strike anyone prematurely. When death takes the life of the family provider, surviving family members often suffer if they are left without an adequate income or means to provide even basic necessities. We're not talking about buying a mansion, just basic necessities, fish and bread, milk and water, just the basics, right? On the other hand, some people face the unpleasant prospect of outliving their income. Retirement may be forced upon them before they have adequately prepared for the non-income earning existence. Sickness and disability can also leave economic scars, often more intense than death. You know, you're more likely, 6 to 8 times more likely to be disabled for a prolonged period of time than you are to die prematurely. You might as well be dead if you can't make no money, right? An accident or illness can easily result in catastrophic medical bills or the inability to work for months or even years. Insurance involved to produce a practical solution to such economic uncertainties. The losses, life insurance, which is based on actuarial or mathematical principles, guarantees a specific sum of money upon the death of the person who is insured. Health insurance also evolved from scientific principles to provide funds for medical expenses due to sickness or injury, and to cover loss of income during a disability. Annuities provide a stream of income by making a series of payments to the annuitant for a specific period of time or for his lifetime. The true significance of insurance is its promise to substitute future economic certainty for uncertainty and to replace the unknown with a sense of security. The true significance of insurance is its promise to substitute future economic certainty for uncertainty and to replace the unknown with a sense of security. I don't know. I think they might have put that backwards. Let me know if I'm wrong, y'all. They said the true significance of insurance is its promise to substitute future economic certainty for uncertainty. I think it should be future economic uncertainty for certainty, but maybe I'm reading this wrong. I don't know. And then they have an illustration 1.1 where they basically show how since the year 1940 on up until 2018, relatively policies, the amount of policies have increased, then decreased. Let's see, well, the overall amount has been going up, but sometimes there's more policies bought than there were. Actually, it's less policies bought in 2018 than there were policies bought in 1940. However, the amount of money is greater, which, you know, that's a part of inflation, right? But, you know, this is just an illustration that's on this page. Let's see if you can see that. Illustration 1.1, life insurance purchases in the United States by ear. All right, so we have 1.2, an industry overview. The insurance industry plays an important role in our society. Illustration 1.1 provides a snapshot of insurance statistics. The majority of American households own some form of insurance. In 2018, the average face amount of a newly purchased individual life insurance policy was $168,000. Premiums for life insurance policies totaled over $150 billion in 2018, a 5.9% increase from the previous year. Annuity premiums decreased from $294 billion in 2017 to $279 billion in 2018. The amount paid out, benefits, dividends, annuity payments, and surrender values exceeded $536 billion in 2018. Most new life insurance policies are purchased by individuals from life insurance agents. According to the American Council of Life Insurers, 2019 Life Insurers Fact Book, Americans purchased $3.1 trillion in new life insurance coverage in 2018 and a 1.9% decrease from 2017. Life insurance in force in the United States at the end of 2018 totaled over $19.6 trillion, a 4.1% increase from 2017. The health insurance industry also vital to our national well-being. In 2018, U.S. Census Bureau statistics indicate that 296 million Americans, 91.5% of the population, had some form of health coverage, which private insurance covering 68.3% of the population. Employer-based private insurance was the most popular, covering 55.1% of the population. Government plans, e.g. medical care, Medicaid, or military, covered 34.4% of the population. According to the Census Bureau, the number of uninsured in America has decreased since 2008. A significant drop in uninsured rate happened between 2013 and 2014 as more provisions of the Affordable Care Act were implemented. More individuals may have become eligible for newly established subsidies or tax credits. Additionally, some individuals became insurable under expanded Medicaid eligibility. Paying for health care remains a challenge for both individuals and the nation. According to the Centers of Medicare and Medicaid Services, healthcare spending accounted for 17.7% of the nation's economy in 2018 and averaged $11,172 per person. Finally, we should note that the insurance industry makes up a substantial contribution to our nation's economy. It is a significant source of investment funds because insurance companies invest the billions of premium dollars they receive annually in a wide range of investments. And insurance companies usually invest in very safe investments, AAA, AA bonds, and usually when they're loaning money on a building like a high rise or something, instead of the typical 80% to 20% loan ratio, which means banks typically cover 80%, and they expect whoever's asking for the money to put some skin in the game, which is about 20%. Insurance companies usually do a 50% 50 to 50 loan to value ratio, which means that they say, hey, we'll put up half. So if it's a $4 million project, we'll put up $2 million. You got to put up the other two, and if you default, now we own all of it. And that's why insurance companies usually come out on top when stuff like that happens, even when the market crashes, because they're already at a 50 to 50 loan to value ratio. They just came up because how often does the market crash over 50%? It might crash 40%. That's happened 2 times in the last 10 years. But how often does it crash over 50%? Insurance companies know what they're doing. For better or for worse. They know how to get over on you, right? The nature of insurance. We are exposed to many perils. The purpose of insurance any insurance, is to provide economic protection against losses that may be incurred due to the chance of happening, to a chance happening or event, such as death, illness, or accident. This protection is provided through the insurance policy, which is simply a device for accumulating funds to meet these uncertain losses. The policy is a legally binding contract that sets forth the company's promise and obligations as follows, whereby for a set amount of money, the premium, one party, the insurer, agrees to pay the other party, the insured or the insured's beneficiaries, a set sum, the benefit, upon the occurrence of some event. In the case of life insurance, for example, the benefit is paid when the insured dies. In the case of health or disability insurance, the benefit is paid if and when the insured incurs certain medical expenses or becomes disabled as defined by the contract. 1.3.1 Basic Insurance Principles. Insurance is based on 2 fundamental principles: the spreading or pooling of risk, also known as loss sharing, and the law of large numbers. To understand these principles, consider the following example. And this is 1.3.1.1, risk pooling. Assuming that 1,000 individuals in the same social club agree that if any member in their group dies, all of the members will pitch in to provide the deceased family with $10,000. This $10,000, it was determined, would provide the family with enough funds to cover the immediate costs associated with death and to provide a cushion for at least a few months. Because it is not known when any one individual within the group will die, the decision is made to pre-fund the benefit by assessing each member $10. Each individual contributes $10, thus creating the $1,000 fund. So $10 times 1,000 equals $10,000, right? As you can see, without the agreement to help provide for each other's potential loss, each group member and the member's family will have to face economic costs of death alone. But by sharing the burden and spreading the risks of death over all 1,000 group members, the most any one member pays is $10. And that $10 is what? Premium / deductible, right? It gets kind of, we're going to get into that. This is, of course, a simplified example, but it explains the basic concept of loss sharing. By spreading a risk or by sharing the possibility of a loss, a large group of people can substitute a small certain cost, $10, for a large unknown risk, the economic risk of dying. In other words, the risk is transferred from an individual to a group, each member of which shares the losses and has the promise of a future benefit. Insurance companies pool risk among thousands and thousands of insurers and apply certain mathematical principles to guarantee policy owners that money will be there to pay for their claim when it arises. Now this is 1.3.1.2, the law of large numbers. In addition to spreading of risk, insurance relies on the principle that the larger the number of individual risks or exposures that are combined into a group, the more certainty there is as to the amount of loss incurred in any given period. In other words, given a large enough pool of risk, an insurer can predict with reasonable accuracy the number of claims it will face during any given time. No one can predict when any one person will die or if any one person will become disabled. However, it is possible to predict the approximate number of deaths or the likelihood of disability that will occur among a certain group during a certain period. This principle is known as the law of large numbers. And basically what that means is the larger the test group, the more accurately the prediction is. And just to give a simple example, imagine when you flip a coin, heads or tails. When you flip that coin the first time and it lands on heads and you don't flip anymore, you can't say that 100% of the time a coin will land on heads if you flip it. But is that true? No, because if you flip it again, it might land on tails or it might land on heads again. So imagine if you flip it twice and it lands on heads twice. Then you're just positive that 100% of the time it lands on heads. But on average, if you keep flipping that coin, if you flip that coin 1,000 times, 2,000, 10,000, 100,000, on average, it's going to be 50-50. The more you flip, the more it's going to get to what it actually is. There's only two sides of a coin. Therefore, there's a 50-50 chance. 50% chance is going to land on heads. 50% chance is going to land on tails. So the larger the number, the more accurate these insurance companies get. So that's why they try to insure as many people as possible that fall under the same socioeconomic group. Let's see. It's based on the science of probability. The principle known as the law of large numbers is based on the science of probability and the experience of mortality, death, and morbidity sickness statistics. The larger and more homogeneous the group, homogeneous, the more certain the mortality and morbidity predictions will be. For example, statistics may show that among a group of 100,000 40-year-old males, 300 will die within 1 year. While it is not possible to predict who the 300 will be, the number will prove very accurate. However, with a small group, the accurate prediction is not possible. Among a group of 100 40-year-old males, it is not statistically feasible to predict if any in the group will die within 1 year. Because insurers cover thousands and thousands of lives, it is possible to predict when and to what extent deaths and disabilities will occur, and consequently when claims will arise. All forms of insurance, life, health, accident, property, and casualty rely on risk pooling and the law of large numbers. These principles form the foundation upon which insurance is based and allow for its successful operation. All right, so we have 1.1, the concept of risk. Let's see how much I got left. Not that long. All right, the concept of risk. As we have learned, insurance replaces the uncertainty of risk with guarantees. But what exactly does the word risk mean? And how does insurance remove the uncertainty and minimize the adverse effects of risk? All right, so we have 1.4.1. This is risk defined. Risk can be defined as uncertainty regarding loss. property loss, such as the destruction of a home due to fire, is an example of risk. Negligence or carelessness can give rise to a liability risk if there is potential injury to an individual or damage to property. The inability to work and earn a living due to a disability is another example of risk, as is loss of a family's income due to the death of the breadwinner. The loss that is involved with all of these risks is characterized by a lessening or disappearance of value. Risk can be divided into two classes: speculative risk and pure risk. Speculative risk and pure risk. This is the definition of speculative risk. Speculative risk. Speculative risk involves the chance of both loss and gain. Betting at the racetrack or investing in the stock market are examples of speculative risk. This is a chance of gain and a chance for loss. Now we have pure risk. Pure risk involves only the chance of loss. There is never a possibility of gain or profit. The risk associated with the chance of injury from an accident is an example of pure risk. There is no opportunity for gain if the event does not occur, only the opportunity for loss if it does occur. Only pure risk is insurable. With life insurance, the risk involved is when death will occur. It can be tomorrow, it can be next week, it can be next year, or well into the future. Loss can result if death is premature or comes too late. How about it? You're taking too long to die. That's a risk, right? With health insurance, the risk is not when, but if illness or disability will strike. Losses associated with health risks include medical costs and loss of income. With annuities, the risk of living too long and outlasting one's income. With annuities, the risk is living too long and outlasting one's income. Annuities cover this risk by paying a guaranteed income for the annuitant for life. All right, so this is 1.4.2, perils and hazards. All right, in conjunction with risks are the concepts of perils and hazards. Perils and hazards are factors that cause or give rise to risk. A peril is defined as the immediate specific event causing loss and giving rise to risk. A peril is the cause of a risk. For example, when a building burns, fire is the peril. When a person dies, death is the peril. When the individual is injured in an accident, the accident is the peril. When a person becomes ill from disease, the disease is the peril. A hazard is any factor that gives rise to a peril. For purposes of life and health insurance, there are three basic types of hazards: physical, moral, and morale. And anybody that's taken any insurance cash, you know that moral and morale is always on, seems like, every insurance exam, no matter what. Moral and morale hazard, but like they're saying, they're going to break down what physical, moral, and morale hazard might look like in life insurance. Physical hazards. Physical hazards are individual characteristics that increase the chance of peril. For example, physical hazard may exist because a person's physical condition, past medical history, or condition at birth. Blindness or deafness are physical hazards. They're like, hey, based off your medical history, based off your conditions at birth, based off your blindness or your deafness, hey, listen, you might walk off a cliff. You might not hear somebody yell, hey, look out for that car, right? It's just, you may have been born with some type of valve in your heart to where they know statistically, everybody's going to die, but you may die sooner. You know what I'm saying? So that's a physical hazard. Moral hazard. Moral hazards are tendencies that people may have that increase the risk and chance of loss. Alcoholism, drug addictions are considered to be moral hazards. So in insurance, what I'm more have more experience in, based off what I put hands on, is property and casualty insurance. But let me read moral hazard, and then I'm going to give you an example of what moral and morale looks like when you're dealing with property and casualty. Moral hazards are also individual tendencies, but they arise from an attitude or state of mind causing indifference to loss. For example, a person may have a habit of driving recklessly with no fear of death or injury. This indifference is a moral hazard, increasing the chance of death or injury. So a moral hazard is basically regardless of what people say, if you're an alcoholic and you're addicted to drugs, that you're killing yourself prematurely. You know that, right? But with moral hazard, just because you drive fast don't mean that you want to die. It's just something that you do, right? It's just a habit of yours that just so happens to be something that increases your likelihood of an early death or disability. So, but to talk about what I was saying, the difference between moral and moral hazard, for example, somebody might leave their keys in their car at night. That's just a habit. They get out the car, they just put the keys, they leave the door unlocked and put the keys under the chair. That's a moral hazard. They don't want anyone to steal their car, but for whatever reason, they just so trusting, right? Or whatever you want to call it. If somebody gets into their car, they're going to check the door. They see it's unlocked. They look under the seat. They got the keys. Car is stolen. Moral hazard. Moral hazard is somebody, they can't afford their car note anymore, so they set it up for a friend, family member, or associate to go ahead and steal it. That's moral. All right. A good way to remember the difference between moral and moral with an E, because they're both spelled the same. It's just moral has a E at the end of it. And a good way to remember it is because moral is considered the good one, if there was a good one. So a good way to remember it is E for See, I have a different way of remembering this, but I don't want to use this way because I know most people won't remember it. It was a friend of mine that had a son and a daughter. They were twins. Shout out to Henry if you're seeing this. And I think his son name was Dennis and his daughter name was Denise. His son, you love all of your kids, right? But his son. Yeah, that's my son, but Denise, I love Denise. So that's the way I helped him remember it, was I say, all right, whenever you think about moral and morale, just remember the good one is the one with the E, Denise. The bad one is the one without the E, Dennis. Yeah, all right. Okay, so we have 1.4.3, treatment of risk. How risk is treated varies greatly depending on the situation, the degree of potential loss, and the individual. Basically speaking, there are 4 options. You can either avoid risk, reduce the risk, retain the risk, or transfer the risk. Let's consider each. So this is risk avoidance, right? One method of dealing with risk avoidance, simply avoiding as many risks as possible. By choosing not to drive your own or own an automobile, one could avoid the risks associated with driving. By never flying, one can eliminate the risk of being in a plane crash. By never investing in stocks, one could avoid the risk of a market crash. Clearly, risk avoidance is effective, but it is not always practical. Few risks can be handled in this manner. So basically saying, hey, one of the ways of dealing with risk is just to avoid it just in general. If you don't want to die in a plane, if you don't want to deal with the risk of dying in a plane crash, never get on a plane. If you don't want to deal with the risk of dying in a car accident, never get in a car. The funny thing is, that's one of those subjective and objective things, because whenever a plane crashes, it's all over the news. But you might hear once or twice, a few times throughout the year, somebody talking about somebody dying in a car accident on the news, but they don't make it a regular occurrence. And just to give you an example, I remember researching one year, a recent year, only 108, approximately 180 some odd people died with plane crashes for the entire year. Approximately 180. Guess how many people died in car accidents that same year? Over 1 million. And it's some people who will never ever get on in a plane because they scared to death of dying in a plane crash, but they're driving a car every day, driving recklessly. That morale hazard, remember? Right. All right. So then we have a risk reduction. Risk reduction is another means of dealing with risk. Since we cannot avoid risk entirely, we often attempt to lessen the possibility of loss by taking action to reduce the risk. Installing smoke alarms in a home will not lessen the possibility of fire, but it may reduce the risk of loss from the fire. So if you don't have a smoke alarm in your house, that fire can be burning all night before it getting burn your ass, right? But if you have that smoke alarm, it's going to wake you up. You're going to call the police. They're going to stop the fire before it burns the entire house down and before it burns your ass, right? All right. So, and then we have risk retention. Risk retention is another method of coping with risk. This means accepting the risk and confronting it if and when it occurs. One way to handle a retained risk is self-insurance. Setting up a fund to offset costs of potential loss is regarded as self-insurance. For example, Dave Ramsey, he teaches keeping, while you're trying to get out of debt, using the debt snowball. He teaches putting $1,000 in the bank. Because if you think about it, how often does an emergency pop up out of nowhere that can't be solved with $1,000 or less? How often? Just think about it. Tire blowed out, can be taken care of with $1,000 or less. Water heater goes out, that can be taken care of with $1,000 or less. There are a lot of things that can be taken care of with $1,000 or less, and you making the conscious decision to put $1,000 up in a savings account and not touch it, but only save it for a real emergency. Your friend just got a deal on a Southwest ticket to Cancun, but you got to pay it by the day or the discount is gone. That's not an emergency, right? But if you truly use that for an emergency, it's very rare that a true emergency pops up that $1,000 or less can't solve it. And that's risk retention. That's self-insurance. That's you saying, I don't need insurance to cover me on that. I'm going to put enough money up or whatever to take care of that. And then you have risk transfer, which is what insurance is. So let's get into that. The most effective way to handle risk is to transfer it so that one loss is borne by another party. Insurance is the most common method of transferring risk, i.e. from an individual or group to an insurance company. Though purchasing insurance would not eliminate the risk of death or illness, it relieves the insured individual or group of the losses these risks bring. Insurance satisfies both economic and emotional needs. It replaces the uncertainty surrounding risk with the assurance of guarantees. It transfers the financial consequences of death, illness, or disability to the insurer. And that's insurance. Listen, I'm a public insurance adjuster, so I know that sometimes getting indemnified, being put back to where you were, isn't an easy task, and you have to fight for your rights. But the reason why you have rights to fight for is because you have insurance. So, it's one of those things to where I'm a very practical person. I get it. It is what it is. Sometimes people might view someone who is a public adjuster as an adversary of the insurance carriers. No, I'm a counterpart. I'm just a necessity in a lot of instances for people who don't deal with insurance on a regular basis. Sometimes you need somebody who deals with it on a regular basis in order to be your advocate, because this is not something that you do regularly, and you're dealing with people who have actuaries doing these math problems, flipping these coins a million times. You need somebody that know how to flip a coin too, right? Right. All right, so now we're at 1.4.4, elements of insurable risk. Though insurance may be one of the most effective ways to handle risk, not all risks are insurable. As noted earlier, insurers will insure only pure risks, or those that involve only the chance of loss. However, not all pure risks are insurable. Certain characteristics or elements must be evident before a pure risk can be insured. The loss must be due to chance. Got to be due to chance. In order to be insurable, the risk must involve the chance of loss that is fortuitous and outside the insured's control. You can't be going out here making stuff happen that can get the policy paid on purpose. It got to be something that just happened out of nowhere, but just so happened because you plan it right, it's insured. A fortuitous event. The loss must be definite and measurable. An insurable risk must involve the loss that is definite as to cause, time, place, and amount. An insurer must be able to determine how much the benefit will be and when it becomes payable. All right? Can't just be like, hey, insure me for this when that happens. The insurance company be like, what? Nah, they needed what they call it. It slips me, but they needed to be something that's measurable. Definitely, the loss must be predictable. An insurable risk must be one whose occurrence can be statistically predicted. This enables the insurers to estimate the average frequency and severity of future losses and set appropriate premiums. Death, illness, and disability are all events whose rates of occurrence can be projected based on statistics. The loss cannot be catastrophic. Insurers typically will not insure risks that will expose them to catastrophic losses. There must be limits that insurers can be reasonably certain their losses will not exceed. This is why an insurer would not issue a policy for $1 trillion on a single life. That one death would create a catastrophic loss for the company. The loss exposures to be insured must be large. An insurer must be able to predict losses based off the law of large numbers. Consequently, there must be a sufficiently large pool to be insured, and those in the pool, the exposures, must be grouped into classes with similar risks. Individuals, for example, are grouped according to age, health, sex, occupation, and other classifications. The loss exposures to be insured must be randomly selected. In addition, the group to be insured must be randomly selected. Insurers must have a fair proportion of good risk and poor risk. A large proportion of poor risk would financially threaten the insurance company because there would be many claims without sufficient premiums to offset them. Keep in mind that there is a tendency called adverse selection for less favorable insurance risks, people in poor health, to seek or continue insurance to a greater extent than the other risks. So adverse selection, and that's why a lot of times, for example, I think when you start a flood policy, even though the policy started, there's no coverage for the first 30 days. Because if that were the case, as soon as someone knew that a flood was coming tomorrow, they would just call the insurance company and get flood insurance and then be covered for tomorrow. That's adverse selection. The insurance company wants people who proactively get that type of coverage. So if and when that does happen, this was a fortuitous event. It was due to chance, and it wasn't something that you saw on the news coming tomorrow and then you went ahead and got coverage. That's called adverse selection. So then now we have 1.5, economic basis of life and health insurance. To fully appreciate the purpose and function of insurance, it is important to understand that its roots lie in economics and the concept of the human life value. It has long been recognized that individuals have an economic value that can be measured in part by their future earning potential. This earning potential is the sum of one's net future earnings, or more precisely, the dollar of an individual's future earnings capability. The true significance of this earning potential extends beyond the individual to those who depend on that individual for their financial security. Thus, by definition, human life value is the value today of an individual's future earnings that are devoted to that individual's dependents. You can find out how much you're worth. And how much you're worth is based off your future earning potential. Some of y'all ain't worth nothing. And listen, I'm just joking. But, you need to step it up. If you really want to find out how much you're worth, try to get a life policy. They'll let you know. Oh, you want $1 million policy? You ain't worth $1 million. You want 100? You're not worth 100. I'm looking at what you do for a living, and it ain't worth that. So what we going to insure you for that? Get on your job, man. Come on. All right. In the abstract, human life value is the means by which homes are purchased, college educations provided, monthly bills paid. In short, it is the essence of an individual's or family's economic existence. Yet, this value is subject to loss through death, retirement, disability, or poor health. Any one of these perils affect earning capacity to one degree or another and consequently diminishes human life value. It is for this purpose, to conserve and protect human life value, that life and health insurance exists. Now, here's the summary 1.6. This is a summary of. All right, here's the summary of Chapter 1.6. Life and health insurance evolved to provide a practical solution to the economic losses associated with death, sickness, and accident. It does so through an insurance policy, which is a device to accumulate funds to meet these losses. Insurance is based on risk pooling and the law of large numbers, the principles that allow insurers to spread risk among thousands of individuals and to protect losses with reasonable accuracy. Insurance transfers risk, which is one of the most effective ways to deal with risk and its losses. Not all risks are insurable, however. There are certain elements every risk must contain before it can be insured. For example, it must be a pure risk. The loss it entails must be due to chance. The loss must be definite and measurable. The loss must be predictable. The loss cannot be catastrophic, and the loss exposure must be part of a large, randomly selected group. The true worth of insurance lies in its ability to protect human life values, the value associated with an individual's earning potential, and to provide financial security. Now, I should have said this at the top of the video. If you really want to pass these exams, listen, read the summary. The summary is going to tell you everything that they thought was important in this chapter. It don't matter what you thought is important. It's what the people who wrote the test think is important, right? And the summary says, it's telling you, if you read this summary and any of this that they're saying doesn't sound familiar to you, you need to go back and reread. All right, so the key concepts of this chapter is speculative risk, pure risk, law of large numbers, elements of insurable risk, hazard, peril, risk pooling, methods of handling risk, adverse selection. Now, I don't know, man. Y'all think I should go through these unit test questions? So, all right, so I'm going to stop it right here, right? Because this is the last thing that I had to do for the night, and it's now 9:51. I started at about 9, I think, as far as on my list of things to do in order for me to be successful. So I'm going to stop right here. But anybody who actually watched this video, if you want me to also in these videos go over the unit test and answers, let me know. Leave a comment, like, comment, subscribe, hit that notification bell. Let me know, because if you, let's say you the only one that wants it, but you never comment and say that's what you want, you're gonna never get it. And let me and if you comment and tell me that, that lets me know you invested. I'm gonna do it just for you, All right. I am Randolph Love III. I'm glad you stuck around with your boy. All right. And I'm gonna be dropping more videos like this because I'm gonna be reading this entire book again. And then when they drop the 36th edition, I'm going to read that entire book. And then I'm going to read it again and 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 again. I want it to be a part of my subconscious. I want to be a part of my persona. I want all of that. I want all the smoke, all the education. All right. And once again, like, comment, subscribe. I'm Randolph Love III. Hit me up, randolphloveconsulting.com, and check out the Entreprenudist podcast, the place to hear real entrepreneurs and business owners bear it all. Gracias.